So, hello, we have once again Professor John Cochrane, who's been so kind to accept to speak to us about asset pricing. Those of you who have watched our previous episode with Professor Cochrane remember that we spoke about his newest book, the Fiscal Theory of Price Level. Today, we'll ask Professor Cochrane to speak about another of his passions, intellectual passion, which is asset pricing. That is, how you assign a value to financial assets or any other kind of asset. And it's a topic which is in the minds of many people, certainly many investors, many of you who save diligently part of their income. So we want to give you an overview on how to approach this kind of theoretical issue and what are the repercussions, what are the implications in real life. So, John, I leave it to you. Thanks once again for accepting our invitation. And what is the most important aspect of asset pricing in your view?
Okay, well, let me tell you what asset pricing is. I should tell our listeners, this is something I actually know a little bit about. I spent 30 years as a professor of finance at the University of Chicago, and I've written academic papers. There's a book I've written called Asset Pricing, which they should not read because it's a PhD level textbook that starts right in with equations. I'll recommend a recent paper, Portfolio Theory for Long-Term Investors, which does not have any equations and might be the most useful summary of what's going on. So what is asset pricing? It is I'll call it scientific field, we do as best as we can, that studies why do prices of things like stocks, bonds, real estate, any financial asset go up and down. When do they go up and down? Part of that is what should you buy? So there is a thing called portfolio theory, the same way that you start an what is economics about? Why does the price of apples go up and down? How do we understand that? Well, supply and demand. And demand is a theory of, how should you, what's the optimal fruit basket? So the same way asset pricing starts with what's the optimal portfolio. That's how we describe demand for stocks. Then we put together supply and try to understand why prices go up and down. So those are two aspects. And I think understanding the world is fun. And also, what have we learned over the years about what's good ways to invest and what isn't good ways to invest? The last thing I want to mention is a little praise for my own field. Asset pricing is perhaps the most empirically connected part of economics. Really, it's not just theory. It's theory meets data, because we have a lot of data on how do stocks and bonds work. And similarly, data on investment strategies. It's not easy, just because your uncle invested with Alberto here and made a lot of money doesn't necessarily mean that's the place to go in the future. So we've done a lot of empirical work on and it's putting those two together that is exciting about asset pricing. And last comment, it's a very active field. We're learning new things every day. Old theories are getting upended. In some sense, what you learn if you study this for 30 years is how little we actually know and how exciting it will be when we learn those new things. Okay, that's asset pricing. Now, what can I tell you?
So can you describe in terms of empirical findings, what are the main lessons that we have learned from research that can be useful for actual investment activities. So, for example, one of the things that people don't understand is that a lot of evidence in theory and in empirical work has to do with the expectations, okay, which is not measurable, and expectation is close relative of trust. So how do we link these rather nebulous, rather unmeasurable concepts with something that is expressed in monetary terms, in dollar or euro terms?
Well, one way, so the central concept of asset pricing is price is the expected discounted value of the dividends you're going to receive. And let's not forget the dividends. There's a lot of focus on short term. Today's, thinking about buying something because it'll go up tomorrow. Well, why will it go up tomorrow? Because people think it'll go up the next day. And how long does that last? Now, except for, old masters and gold bars and Bitcoin, every other asset that anchors itself on in the end on the dividends. So where do those expectations come from? Well, that's hard to tell. And you've hit the nail on why empirically this is a difficult field. But what we can do is we can look, we don't know what people are thinking today, but over long periods of time, on average, people aren't that dumb. So if you look at averages over long periods of time, you can get some sense of what expectations are at any moment. You'll never explain why prices are $257 today. What are people thinking? I don't know. But you can get a sense. For example, when prices go up, historically, what's happened afterwards? Have we seen dividends rise, or have we seen that the prices tend to come back? What's in people's expectations on average of prices go? Actually, that response is a little bit interesting. For individual stocks, some of it comes when prices go up. Afterwards, on average, dividends do rise. So people were seeing something. Also, on average, a lot of times the prices are high and then the prices come back down again, which might be risk premiums are low, or who knows. So I want to, what is asset pricing? Let me start with statement number one of asset pricing. You look around and you will see that some kinds of investments earn more money on average than other kinds of investments. So stocks earn more money on average than bonds. Historically, stocks have earned in the 5-6% range, bonds in the 1-2% range. Why doesn't everybody just hold more stocks? Well, obviously, stocks are riskier. So that's what we do. We try to understand why is the world the way it is. There's always this tension. What could you do to make more money? But then, supposedly George Stigler once turned to Milton Friedman and said, look, there's a $20 bill on the sidewalk. And Milton Friedman said, no, that kind of happened. Somebody would have picked it up already. So with our other hat on, we try to say, well, if there's some golden opportunity, but it's sat there for 20, 30 years, maybe something's wrong with it. And indeed, stocks are riskier than bonds, but just how riskier? And is that a risk that applies to you? That's the central questions we ask.
Yeah. So what you're saying is that there is a rational way of looking, or let's say a consensus way of looking or estimating asset prices. But what we observe often is a bubble. No, we've seen over the years valuation which were out of, let's say, line with traditional valuation methodologies. We've seen crazy prices for rather unlikely ventures. We see this also, you mentioned Bitcoins or cryptocurrencies in general. That's a phenomenon that is not linked to some sort of measurable or observable fundamental. So how come then, if the people are not tendentially wrong for a long time, that these bubble happen and it might take a lot of time before they burst?
The great bubble word. Everybody loves to look around and say, bubble, bubble, bubble. But I know what our listeners don't know, that private island you're apparently living on because you spotted the last bubble and made billions of dollars on it. It's so easy to look back and say, oh, what bubble, bubble, bubble. But if you really knew it was a bubble, you could have made an unbelievable fortune ahead of time. And there's not that many people who actually can reliably do that. Bubbles only show up after the fact. And so that's the difficulty. The things do look crazy sometimes, but sometimes crazy stuff pays off. I thought Amazon and Apple and Google were bubbles in 1999. I didn't buy them, and look at me, I got to work for a living just like you. That's not a private island. In fact, there are those houses in the US. Everyone said bubble, bubble, bubble in 2008. Guess what? House prices are back up even higher than they were in the time of the great housing bubble. So it's off. So technically, a bubble means a price that is high only because somebody expects somebody else to come along and pay an even higher price. And for some reason, people are dumb because we all kind of eventually know it'll blow up, but we all think we can get out before it happens. And half of us are wrong about that. Well, how often does that happen? I think this is one of these, finance gets into these semantic debates. So what are the facts that we know about this bubble question? The fact is, there are times when individual stocks, individual securities have apparently very high prices, and that seem weird compared to what seems reasonable about the earnings. Now, who knows? But we do know over time, on average, many times of high prices relative to dividends, earnings, so forth, have not ended up with those great growth in dividends earnings that people thought was going to happen, but in the prices coming back down again. So that you can call that a bubble. Schiller likes to call that a bubble. If you look on my blog, there's a great coverage of the debate between Schiller and Fama at the Nobel Prize over what's a bubble, what isn't a bubble. And it was really fun. Fama, asked Schiller, give me one thing that I could look in real time and call it a bubble. And Schiller says, no, I'm not going to do that. A bubble is whenever I think it's a bubble. It's kind of like a literary thing. Anyway, what's the fact? The fact is times when prices are high relative to dividends are typically times when the prices come back down again, when the returns after the fact are not negative, but low. And not, what you might think, that high prices signal great growth in dividends coming in. So what does that mean? Well, let's look around at those times. And conversely, times when prices crash, 2008, prices crashed relative to trading dividends. Was that because people thought a new Great Depression was coming? Well, some people surely did, but not everybody on average, and they were wrong. If you bought time travel, go back to March 2009 and buy everything. Looked like a negative bubble in retrospect. And one more, why didn't I buy? And I was scared like everybody else. Well, but also, what else was going on in fall of 2008? Oh, there was a huge recession and a financial crisis. So it also makes perfectly rational sense that prices are low and expected returns are really high because everyone's scared to death. The economy is tanking. They're about to come repossess the house. Your business is about to go under. You might rationally say, look, I see that this is a very low price. These dividends are on sale, but I can't afford to take the risk right now. Conversely, when is there a positive bubble? Well, it's not just random. It's times when the economy is doing great and people are flush with cash, and you know kind of that the returns on this aren't great because it's a bubble. The prices are high. We don't know when it'll fall, but it's not a great investment. But what else are you going to do with your money? The economy is doing great. Your business is doing great. You want to invest. Everyone's trying to invest. So there's nothing in finance that says that the risk premium on stock, the expected return going forward, is constant over time. And in fact, it makes perfect sense that the expected return is sometimes high in bad times when everyone's scared to death, and sometimes low in very good times. So I kind of take that macroeconomic view of what looks like a bubble. There's a common fact. The bubble guys cite it and the rational guys cite it. I'm one of the rational guys. But the common fact is that high prices often are a sign of low returns going forward. But it's also a time of low. People are willing to take risks without a great return, sensibly, because the economy is doing well. And that's also true of individual things like, Bitcoin. Let me show you the grand bubble of all time, money. You have some, I have some. But here we are sitting on a zero rate of return asset. Are we out of our minds? Money's a bubble. There's no dividend whatsoever. Money's a bubble, right? But there it is. But why do you hold money? Well, you don't hold a lot of money. You hold just enough money to buy, the pina coladas off. I can see behind you. I'm going to keep making fun of your background. Just enough money to make your transactions. It has a liquidity service, which justifies its low rate of return. And Bitcoin can work in some of the same.
But for example, speaking of
if
bubble,
you think you can tell bubble time, good for you, and go make some money off of it.
Yeah. No, but for example, we might not call it a bubble, but what has happened recently with the sudden turnaround of monetary policy, before the quantitative tightening, before the tightening cycle of interest rates, everybody was happy to hold corporate bonds or government bonds with very low yields, and was that something irrational in some sense, or you can say, well, it was guided by the authorities, it was guided by the expectation that monetary policy would never change? You see, it is difficult to think that, for example, in Europe, negative interest rate could last forever. Yet a lot of long-term investors, such as pension funds or even banks, piled up their balance sheet, piled up in their balance sheet these securities, which were, not with hindsight, but with premonition, rather risky. How do you explain this? What do you make out of it?
A couple of things are important for your listeners to realize. So central banks set interest rates. They set nominal interest rates. There's a price that is straight from them. But they don't set real interest rates, what you get after inflation. Inflation comes, as we're discovering, quite despite the wishes of central banks. So the real interest rate, what you get after inflation. Now, the central bank's prices are a little sticky, so it takes a while. So central banks influence real interest rates for a while, but not forever. So when we try to understand the long period of low real interest rates, almost all economists run not to central banks did it, but more fundamental forces in the economy. The savings glut, demographics, low investment opportunities, whatever you want to call it. So don't put too much attention on central banks. And, in some sense, I was almost calling bubble too. I've spent 15 years saying, what are you doing? Interest rates have got to go back up again. What are these negative interest rates? And I was wrong every time. Got all those guys with the world is ending signs out. Finally, I'm right. And there is banks especially, they make money betting on interest rates going down. And when interest rates go the other way, they run to our central banks and get bailouts. So it's not necessarily irrational for them to take that risk. What's weird is that the central banks let them get away with it, which was this is a separate issue, but our financial regulatory system is absolutely broken. If our central banks cannot detect interest rate risk, the banks are betting on interest rates going down, and the central banks know that if the banks fail, they're too big to fail, and the central banks are going to bail them out. So central banks are supposed to watch that interest rate risk. We've understood this since about 1740, and yet they blew it. But we're veering off into financial regulation. So let's get back to your question about interest rates. But yeah, so real interest rates vary over time, and a hard question is, are we permanently in an era of back to an era of high real interest rates? Or are we going to go back to very low real interest rates once things settle down? I don't know. There's good arguments on both sides.
There is a paper by the. Go ahead, Alberto. Go ahead.
John, why did you write a book on asset pricing?
Oh, because I knew something about it. So I had spent 20 years teaching classes in the theory of asset pricing. And when you teach, you start to understand things better and better and clearer. So the world needed a together in a digestible, easy way. And I thought I had some insights on how to structure it. So, that's what they pay me to write, and write what you know about.
Well, why, in which way does your book differentiate itself from other books on asset pricing?
So my asset pricing book is a book of theory. It synthesizes, what we know about the logical structure, how we think about asset pricing. And what was new about it is every theory develops from complicated to simple over time. When you study physics, you don't read Newton in the original Latin. You read a modern textbook, which has, I don't know if you ever tried to read Newton. I've looked at it. It's completely incomprehensible. And, we simplify things. You kind of work things backwards. So I did things backwards. It turns out the most recent models were the simplest. And most other books went history of thought. We learned this, we learned that, we learned the other thing, and then present the final model as the most complicated. But that's not true. The final model was the simplest, and everything else was a special case. So I think I did the world a service by really cleaning it up and showing how apparently complicated models were really simple and how they work. By the way, I need to go back and write a new edition, because all sorts of interesting things have gone on in asset pricing since then, but someday.
One of the pillars of asset pricing, or better to say portfolio choice, is diversification.
Let's get to portfolio. I want to get to portfolio choice, because that's
okay.
That's what everyone's going to be interested in, not us fighting about bubbles, because bubbles is what you fight about at 2 a.m. when you've had too much to drink. Go ahead. Diversification.
Diversification, most people, even most professional asset manager, think still in terms of alpha and beta. Beta is the link between a certain asset and the total market, financial market movements. Alpha is something that is characteristic of that particular asset, that particular stock, something that is not necessary, it's not linked to market movement. So it's the specificity of the asset that you want to invest in some sense. So what is diversification? How can one effectively diversify? And is the correlation as a statistical tool useful to diversify efficiently or sensibly your portfolio?
So a bit is sort of the basic concepts, the basic useful concepts of modern portfolio theory. Right or wrong, these are useful concepts and a great way to think about it. The first one you mentioned is diversification. Don't put all your eggs in one basket, said Jim Tobin when asked to summarize his Nobel Prize. There's always risk, but when something will go up, when something else will go down, and if you spread your investment over multiple things, then the total risk of your portfolio is going to be a lot lower. So that's principle number one of good investing. You won't, yes, your brother-in-law came back with this hot tip, but maybe not. So spread it around, and then you can reduce your risk for free by not over-concentrating your portfolio. Now, this is an interesting one because, on the other hand, the people who've gotten immensely wealthy, the Mark Zuckerbergs, the Bill Gates, and so forth, have done so by having dramatically undiversified portfolios, but also being right. Because there's a lot of people out there with very undiversified portfolios who are now working for a living because those companies didn't work. So it's kind of a paradox. It's kind of like a casino, and the only way in a casino you really make a lot of money is by being undiversified and being lucky. But to calm yourself down on that, recognize this is one thing we do a lot in finance: selection bias. There's another big concept to remember: selection bias. If you get a bus of people coming back from Las Vegas and you interview the ones with happy faces and bulging pockets, you'll get a story about how wonderful Las Vegas is. But interview everybody, and you'll find there's a lot of losers too, and a lot more luck separating the winners and the losers. You know, why doesn't Netscape, AOL, Time Warner, and Yahoo, the ones, you know, why is this? Well, there was a lot of luck there. So diversification is a great principle, and it's one that people are very reluctant to do. A lot of people want to invest in their own company. They want to invest in their own industry. They hold very narrow portfolios. They put too much money in houses, things that have a lot of what we call idiosyncratic, a lot of risk that you could get rid of just by spreading it around. Alpha and beta. Now, there's a way I can boost your returns. Give me your portfolio, and instead of like 2%, I can get 6% out of it. How do I do that? I move you out of bonds and into stocks. I don't have any particular thing, but over a long run average, if I take your portfolio from bonds and put it into stocks, I'll get 6%. Now, you also get the volatility of the stock market. But a lot of apparently very clever portfolio strategies that a lot of people charge a lot of money to do amount to just taking on more risk in the stock market. You can achieve the same average return and volatility of returns by simply going into a low-cost index and saving. If somebody's trying to sell you investment advice and making a lot of money, ask them what their beta is, because that measures to what extent can I get the same return just by passively investing in the market. And often the answer is surprisingly high. By the way, there's also a lot of hiding beta, a lot of private equity, venture capital, real estate investments, and so forth. You don't know what it's worth on a daily basis. And so it's easy not to see that these things that are really just getting an average return because they go up and down when the stock market goes up and down. So it's the counter of diversification. When you put all your eggs into different baskets and all the baskets fall at the same time, well, that's, stock market risk. There's a component where everything falls at the same time. And that's the undiversifiable risk, which you have to bear. So the best you can do is hold a broadly diversified index and understand that has risk in it. Alpha is then what supposedly we can earn over and above that, the mysterious chase for alpha. But before I let you ask me another question, I want to introduce one more great concept. Remember this one. It's called the average investor theorem. The average investor has to hold the market portfolio, because on average, you hold the average. For everybody who overweights stocks in Microsoft, somebody else has to hold less Microsoft. So anything other than just a passive low-cost market index is a zero-sum bet. For everyone who gains, someone else loses. Now, you may be smart. You maybe know that Microsoft's about to go up. But the guy who sold it to you thought he was smart too. And one of you is wrong. And we can't all be smarter than average either. So that's a very powerful theorem. Think hard. When you do anything other than hold the market portfolio, you're betting that you have to think you are different from average somehow to justify that bet. And if you think it's because you're smarter than average, well, so does everybody else. Now I'll let you ask a question, but there are good reasons you might be different from average. But this is a very powerful theorem. The average investor must hold the market portfolio, only do something different if you think you are different than average in some justifiable way that we all might agree. And that thought is what leads many finance professors. I spent my 30 years as a finance professor. What's my money in? Total market index as low cost as I can possibly get it. Why? Because I don't think I'm smarter than anyone else about the business of seeing what's going to happen in the future. So wait, I want to review. Again, my lesson, we talked about diversification, alphas and betas, and the average investor's theorem. See, I used to teach MBAs for 30 years. I still know what I'm doing. No PowerPoint behind me, but you'll have to watch.
Okay. No, but one remark on this obvious concept that you just expressed, that when somebody buys, somebody else sells. And, this is something that I always underscore when they go, speculation, the speculators have pushed the price up or down. I say, well, but who is the speculator? The guy who sold or the guy who bought? Because, maybe the speculator was the lucky guys who was trying to be smarter than the others and lost his money. But anyway, there are two.
I want to interrupt you here because you're onto something fascinating. And of course, the tradition of finance professors is when a newspaper says, oh, the market went up on a wave of buying, we point out, yeah, and there was also a wave of selling because the total amount is the same. But it turns, so for years and years, we made fun of that. And then people went out and looked at the data. And very uncomfortably, it turns out to be true that in many markets, now there's always a buyer and a seller, but you can tell empirically, did the trade start with somebody putting in a buy order, or did the trades and somebody else matching it, or did the trade start with somebody putting in a sell order? And in many markets, there is prices do go up when most of the trades come from buy orders. So that's very uncomfortable. And it does look like, at least for a while, at least in the short run, in some markets, for maybe as much as a month or two, prices do go up when, for some reason, which we don't really understand, people go in and buy a lot of money. Now, I mention this because this is the forefront of finance. If this were true, of course, there would be a lot of money to be made by going on the opposite side of it. And when we look out there, people who are actively trading don't on average make a lot of money. So there's a big puzzle there. But the data do suggest that the big, I think, thing missing in asset pricing, we have faith that if prices get pushed up, investors like you and me will say, oh, well, I'll get rid of that stuff. And if prices are pushed down by a wave of selling, people like you and me will say, oh, there's a deal, and we'll come in and soak it up. That force doesn't seem to be as strong, at least in individual markets, at least at high frequency, as it ought to be. So maybe it wasn't so stupid as we thought all along. Anyway, please go ahead.
Well, the natural question that arises when you say it's better to buy the market, so an index, but which market? Let's say the S&P 500, the MSCI Global, or I don't know. For example, for an Italian investor, the market is the Milan Stock Exchange. But then it's a very narrow stock exchange because it's heavily it has a heavy weight of, say, banks, utilities, and it does not reflect the Italian economy, not to mention the European or the world economy. So what level of, say, market one investor should look at, considering that there is also an element of exchange rate risk? So if I buy the MSCI and I'm a European investor, I'm subject not only to the equity risk, but also to the foreign exchange risk. While if I buy an index of the European stock markets or the Euro area stock markets, I avoid this kind of risk. So this is the first question. Where, what is the border of my market from an investor point of view? The other thing is, but is it true that especially stock market performance is determined by percentages is close to 80 or even 90%, is determined by macroeconomic conditions? So it doesn't happen that the market goes up, the stock market goes up during a recession or right before a recession, and vice versa. So most of the investment decisions must be made with a lot of attention focused on the economic cycles, or more generally to economic medium-term conditions.
You asked two great questions, and I know my habit of giving way too long answers, but I'm going to work hard on not overdoing it. So absolutely,
please go ahead.
Stock markets are correlated with economic conditions. That is definitely right and very important when you think about investing. Now, there's two parts of that. Part of it is
because just to interrupt you one second, because this kind of notion, you'll be surprised how little is understood by asset managers, by portfolio managers. And I sat on trading floors in big investment banks, and this notion that, you see, the equity returns depend a lot on economic conditions, just doesn't sink in.
Well, there's the quip that the stock market has forecast 9 out of the last 5 recessions, which is true. Stocks also go up and down, maybe on fears of recessions that didn't happen. They go up and down on their own, but they very do reliably go down when there is a recession. So I think there's the two, there's the yin and the yang here. Between stock returns and economics. So you're going to try to trade by guessing macro forecasts and try to bet on the stock market going up in good times and bad times. That's very difficult. So the idea that you're going to outperform, you're going to be the smarter guy than the other guy by knowing whether a recession is more or less likely. Good luck to you. That's part of this active management, active trading, which is a zero-sum game and very difficult. But the other part is very true, the risk management side. And I think when you start investing, before you get greedy and drool at all the great returns you're going to make, think hard about risks. I think that's another big point to make. It's about managing risk. So the 9 out of 5 quip says, betting on, I think a recession is more likely than everyone else, so I'm going to sell now, or I think it's not, I'm going to buy now. Good luck on that. That's the 9 part. But when there's a recession, there will be a decline in stock values. And that means the risk management part. When you invest in stocks, this isn't about active trading, this is about risk bearing. You had better be sure that when the recession, financial crisis, whatever comes, stocks are going to fall. You had better be in a position not to need that money right now. And in fact, ideally, you should be the kind of person who can double up when the prices fall, because everybody else is going to be panicking and selling like crazy. Now, that's the risk management part. So there's this, stocks pay more than bonds on average. If you look back over long spans of history and think, what if my grandfather had bought stocks rather than bonds? You would own that private island right now over decades. So why doesn't everybody do it? Well, because stocks do fall in bad economic times, and most people can't weather that bad economic time and wait for them to come back up again. So that's the second part of your question. The stocks do fall in bad economic times, and you had better be able to bear that risk. And now we get to your first question, which I think is related. I proclaimed the average investor theorem, which says the average global investor holds the global market portfolio. And if we're all the same, then we should all hold the same thing. The only reason to do something different is if you're deluded, you think you're smarter than everyone else, which half of the people are at least deluded about that. But we are different from each other. So this opens the door to much more interesting investing. And, you take a class and it says, just hold the market portfolio and isn't really clear on which market portfolio. Well, we are different from each other. And this is, I think, what really opens the door to a rigorous, fact-based way of thinking about what should I do different from everybody else. So suppose you're a tenured professor and you know that in the next recession you can weather it. Well, actually, you're in a great position to hold stock market risk that will fall in the recession. When the recession comes, in the time when everyone else is selling, because they're more exposed to that risk. Conversely, if you own a machine tool company, when the recession comes, your company is going to be in trouble. You are already, in some sense, bearing a lot of stock market risk because the machine tool company is a risky asset. You're not in a good position to bear additional risk to really go into the stock market. And you certainly, your investments should not be in the machine tool industry, which is all going to fall in the recession. Put your investments in, I don't know, tech or some other country or something that's not correlated with your business. So you can think clearly about investing differently from the global average portfolio if you understand my ability to bear risk is different. And where do I live is different. So I'm finally going to answer your question. The Italian investor. Well, so we, as academics, we had this theorem, hold the global market portfolio. And then we look around and people tend to hold their own country portfolio. And that's called
home bias, it's called.
Home bias, exactly. And it was one of those, people are behavioral, people are dumb, they only hold stuff in their own country. But maybe it's not so dumb after all, for exactly the reasons you mentioned. I largely want to buy things that are denominated in dollars. if you want to buy things that are, produced in Italy or denominated in euros, it is true that dollars and euros don't adjust immediately when the exchange rate change. If economies work perfectly, when the exchange rate changes, all the prices should change at the same time, so that the real purchasing power doesn't affect it by exchange rates. But that's not true. The real purchasing power of the dollar versus the euro is very affected by the exchange rate. So if you want to buy things that are priced in euros, that's a reason for holding investments that are at least skewed more towards euro. Don't put it all in Italy, but it's euro, not Italy. But even Italy, the prices of things in Italy diverge from prices of things in Germany. So that risk bearing gives you a reason to say, well, maybe I should be more in Italy. On the other hand, since your salary is paid in Italy, and since you're exposed to a lot of Italian risk, especially within the Eurozone, I don't think investing in just the Milan exchange is a good idea. And also institutionally, America is here ahead of Italy and much of Europe. So I'll offer investment advice. There was way too much investing in real estate and bank accounts and local stock exchanges. Talk to your American colleagues, and everybody has I have a Vanguard account, but any of the large index funds allow you to hold at least a Europe-wide, and Italians should have some global. You should have, and holding a low fee passive index fund, and not just putting your money in banks under the mattress and in local real estate or a few local companies is very good investment advice, despite what I just said about we're all different from each other. So you don't have to jump to the global market portfolio. There's reasons not to do that, but the average Italian should have more of a global and Europe-wide index invested in stocks than they do.
Okay, John, we know that you have another call in a few minutes. So, Alberto, I don't know if you want to make a final remark or ask a final question.
No, I think
We have to wake up Alberto.
no, very, very carefully. I'm not as an expert as you and Fabio are, so I try to catch up.
Well, okay, so we lost you, John. Just guys, I think I've lost you because the connection is not perfect. It's somewhat faulty. So I hope you hear me.
Then what should you hold? But you plan to live a long time. Well, what you should hold is a indexed bond, long-term indexed bond, the longest you can get. Ideally, if you could get them perpetuities, which haven't been for sale since the time of Queen Victoria, but they should be. So what do you get with a long-term bond? Why is that the answer? Well, it's perfectly obvious if you think about it. If you buy an indexed risk-free bond, then you get the same real payment. So it's a payment of 1,000 euros this month. And then if there's inflation, you get 1,010 euros next month. It protects you for inflation, pays the same amount for the rest of your life. That's it, right? Risk-free, long-term investment. But open the statement. When interest rates go up, the value of that thing will plummet. Long-term bonds, and pension funds found this out. Banks found this out. Long-term bonds are risk-free investments to someone who wants to eat the cash flows every month. But if you look at the statements, it looks like you lost a ton of money. But when you lost, come back again, because it's a risk-free bond. It pays the same amount. When interest rates come back, the price will come back, and you don't care about the price. You are there just to eat those coupons, which are totally risk-free. And Bob Shiller said this about stocks too. Why to buy stocks? Buy them for the dividends. A long-term investor is not interested in the ups and downs of prices and can take some confidence from what we know about stocks that a lot of the declines in prices will reverse themselves. So the advice for this hypothetical totally risk-free investor who bought, inflation-protected bonds, tear up the statements. When the statement comes in and says you just lost half your money, you weren't planning to sell those bonds. You were planning to just eat the coupons. You can still eat the coupons. It's like a house. Actually, houses are much the same way. They're terrible investments because they're so illiquid and they don't earn a great rate of return. But, when you hear that the price of your house went down, what do you care? You can still live in the house. You're there to, consume the living in the house, which you still get to do. So the same attitude, I think a long-term investor should spend a lot less time thinking about the ups and downs. You aren't planning to say, you said you lost a lot of money, but you look like a young guy. You're going to last low. You're not going to sell that tomorrow, right?
No, I'm not.
Don't worry about that. What you should worry about is whether this can pay a stream of it. Now, stocks are still risky. When the price goes down, some of that does reflect a long-term loss in value that the dividends you're going to get will go down, but not as much as it looks. So take heart, invest for the long run. Think about how this is going to support your lifestyle over the long run. Not don't worry too much about the ups and downs each month.
Thank you. Thank
John,
you.
thanks a lot. We probably ask you again to make it maybe delve more into some of these topics that you so brilliantly explained. But for the time being, we thank you also on behalf of our our subscribers, and we wish you a great day and a great future as a professor and as an economist.
Thanks
All the
to you as
best.
well.
John, thank you.
Salute to all your listeners, and look forward to our next one.
Bye.